Okay, so it seems like for a very long time we've been talking about Expo 2020, somewhere down the line, getting the build up for Expo 20. It's pretty much upon us now. We've got just over a year until the gates open on Expo 20, and the conversation is very much turning on to legacy. So it's not just about what does Expo 2020 mean for Dubai and for the hotel sector, it's about what comes next. And our next speaker, Sarah Duignan, she is the Director of Client Relationships at STR, is going to look at the experiences of past mega events, Olympics and World Cups, etc., and what we can learn for that for the Expo 2020 community. So please welcome Sarah to the stage. Thank you.
Hi, good afternoon, everybody. A pleasure to be here at the 15th edition of AHIC 2019. So I'm going to spend my 15 minutes taking you through not only Expo, which will come towards the end, but starting off looking at Olympics. We'll look a little bit at World Cup, last 3 Olympics, World Cup, and then into Expo and where we are for Dubai year to date at the moment. So before I start off on the numbers, I think it's fair to say that these 3 different mega events are very, very different. They have different durations, ranging from 17 days to a month to, of course, the 6-month period, which Dubai will experience with the Expo. Also, the economies for these 3 different locations are very different, and also the kind of political setup, or the setup in general, being all around the world, quite literally, Asia, Europe, and to name but a few, and of course then the Middle East as well. So let's kick off by looking at the last 3 Olympics. So if we start looking at Beijing, London, and Rio. So Beijing, we're going to look at occupancy and at the average rate for Beijing, London, and Rio. So if we look at the year before is the first bar that you see, the year of these particular 3 Olympics is the middle bar, and then the year after is the 3rd bar along. So if we look at Beijing, and these are all in local currency I'm presenting to you here, but if we convert those into US dollars, we're looking at Beijing sitting at about 150 US dollars during the year that they hosted Olympics. We're looking at London sitting at about 170, and then we're looking at Rio sitting at about $145. Different dynamics, and we'll talk about supply and the demand in just a moment. One thing you'll notice here is that the average rate grew irrespective of where the Olympics was. So whether it was in Beijing, London, or in Rio during the year of the Olympics. However, the occupancy fell quite considerably in Beijing, very nominally in London from 82 to 81%, so all but flat, and again in Rio by about 10 percentage points. But the question is, on a year-on-year perspective, was it better or worse? So you'll see, like I said, really strong average rate growth across the spectrum. So double digit in both, almost double digit in Beijing, 19.4% in Beijing for average rate, in excess of that in Rio, and then more kind of muted average rate, 4.6% when we look at the London piece. So let's just look at Beijing in a little bit more detail. We're going to drill down a little bit into the numbers. So we're looking here at the entire year, so from start to finish, the 1st of January right through to the 31st of December. And you'll see in those few months before the Olympics took place in Beijing, which was of course in 2008, we saw declines in occupancy and not huge increases in average rate. You then have that heady increase over the 17-day period when the Olympics took place. So we had about 10% increase in occupancy and a whopping 337. Remember, that was only for the 17 days, not for the entire time series, although that would have been quite nice if it was for the whole year. If we look at that for London then, so a very similar kind of pattern for London, but less volatile in the London market. Many of you will remember that London utilised a company called LOCOG, so the average rates in London were capped, so it wasn't a free-for-all, if you will, on average rates. So London still did exceptionally well. So again, over that 17-day period, more muted occupancy growth, but very, very strong average rate growth, so 84% over those 17 days. And you'll see also in London, we've seen a little bit of increase in occupancy in the months and days post-Olympics also, which was unlike what we saw in Beijing. Look then briefly at Rio, very, very similar patterns, so where you're seeing those declines in occupancy in the months leading up, and then not quite the heady heights that we saw in Beijing in terms of average rate, but certainly nothing to be too disappointed about when you grew average rate by 241%. If we look then at the supply and demand, the navy blue being the demand, the supply being that kind of teal colour, and these three different markets are coming from very, very different bases. So during the year of the Olympics in Beijing, they had about 166,000 rooms to sell every night. London had about 118,500. And then Rio only had 30,000, so a much, much smaller market in Rio. So you'll say Beijing the year prior, double-digit supply growth, and actually the year of well into double digits, so heading towards 16% supply growth, and also grew quite significantly the year after. Maybe that was some projects that ran over. London, very similar when it comes to supply growth, so seen, although smaller numbers, so about 4.5%, 5%. But you see that we had that displacement in London, so where there wasn't as much corporate business coming into the London market, and that was replaced in the following year, so you see that significant demand increase in the year after. And then Rio was a very, very different picture. Huge amount of new supply went into the Rio market and continued to come into Rio in the years after, whilst demand started to fall, so we didn't have that replacement of business. If we touch then briefly on the World Cup, so we look at Brazil and at Russia. So Brazil, again, very interesting increases in supply. The only year that grew was the year that they hosted the World Cup, and that was by 1.3% that demand grew. By comparison, Brazil, which was obviously only last year, grew by 5.6% demand. If we look then at Russia and Brazil, so the 14th of June to the 15th of July and 18th, and similar dates then in 2014. So actually no occupancy growth, so actually a decline in occupancy, but a pretty hefty increase in average rate during the period, and then a very nominal increase in occupancy in Brazil, and again very heading towards triple-digit increase in average rate over that month-long period. Remember, it's only a month, so a much bigger opportunity to kind of to divulge that average rate into the 1 month period. Look at the average rate then across both Brazil and Russia. Russia certainly fared much better in terms of percentage growth. This is all percentage growth. It grew 2.5 times faster, or 2.5 times quicker than what we saw in Brazil. And on an average year, the year before each of these locations hosted World Cup, their average rate was very similar, so somewhere between kind of 75 and 80 US dollars. So coming from a very, very similar base. So let's move things along then, and let's look at Expo. So we're going to look at the last two Expos, Shanghai and Milan. Couldn't be more different if you tried. Shanghai during the year of Expo, had 193,000 rooms to sell every night, on average. Milan had a mere 34,000, so a little bit less than 20% of the rooms to sell. So Shanghai is probably is definitely the more comparable market to Dubai. So Dubai has somewhere in the region of about 110,000 currently, and heading towards having somewhere around 140,000 in time for Expo, which I'll touch on in just a moment. If you look at the demand, so demand heading towards 40%, 39% to be precise, during the year of Expo. And then if you look at Milan by comparison, it's heading into kind of 12%, a little bit less than 12% demand growth. But again, coming from a much lower base in terms of what was available to sell. If we look then at Shanghai and Milan, and one thing to point out here, and all of you know this, but just as a kind of reminder, both Shanghai and Milan had Expo during the same year, so during the same calendar year. So May 1st through October 31st, and of course Dubai will host Expo over 2 years, 2020 and 2021. So diverging over the 2 years. So if we look at what happened during that 6-month period for both Shanghai and Milan, so Shanghai grew about 40% in occupancy, about 30% in average rate over those 6 months. Milan 17 and 27. And that's not to say that Dubai will follow suit. Remember, it's a very, very different playing field and a very different quantity of rooms that are to be for sale in the Dubai market. Shanghai attracted about 73 million visitors. and Milan attracted about 20 million. So more in line with kind of what Dubai is looking to attract. However, Shanghai more similar when it comes to the quantity of rooms. They're certainly closer than Milan is. If we look at then at Shanghai over time, this is what we call a stacked chart. So if you were to run along the top of those red blocks, you'd see actually what the RevPAR was for the Shanghai location. Shanghai had a very successful June when they hosted Expo. So the second month of Expo was very successful for them. You'll see that about a third of the way along the chart, where RevPAR was heading towards, on certain nights, 160, 170% growth. That was not sustainable over the 6-month period. And you'll see kind of the second last month, or heading towards the last month, is when we saw those lifts again, and certainly into triple digits, but not the 160 to 165 we saw initially. If we look then at Milan, the growth was certainly smaller than what we saw in Shanghai. Shanghai had about 2 million visitors that could access the market within a 2-hour period. Milan was a little different, both in the room stock, like I mentioned already. But it was really the last 3 months, the latter part of Expo, where Milan picked up the most amount of business, certainly on the average rate side of things. So let's just pause and look a little bit at Dubai. So let's just do a little bit of compare and contrast. Where are we with Dubai so far? This is a compression analysis that we do for Dubai. This is looking at full year 2018. So we have 4 different quadrants here. We have 0 to 70% occupancy working from left to right, 70 to 80%, 80 to 90, and then 90 plus percentage occupancy. So what we're saying here is that first far left tower block that you see is in 2018, there were 112 days in Dubai when occupancy was less than 70%. If you roll over to the far right-hand side, on your far right-hand side with the navy blue, there were 29 days when occupancy was in excess of 90%. Probably the most important figure on here is that 101%, 101% you see right in the middle over that kind of perforated line. And that's the difference in average rate. So average rate goes from about 450 heading towards the 900 mark on those 29 days. Certainly a lot of yielding that goes on in the Dubai market. So obviously 2018 is heading towards 3.5 months ago now. So let's just look at where we are year to date 2019. 0 nights when occupancy has been less than 70%. So we're really focusing on that 70 to 80% piece there in the middle. So 16 days when occupancy was less than 70 or between 70 to 80%, but then only 9 days when occupancy has been in excess of 90%, and about 49% pricing power or yielding happening in the market. Average rate sitting at somewhere around the kind of 650 mark and going up to about the 930 mark. Let's look at the supply then just briefly. So if we look at the existing supply as of April 2019, so fresh off the bat, looking at where the supply currently sits. So about 20% of all the existing supply in Dubai sits on the Palm and beaches. If we look then at Airport and Creek, that's about 30%. So the DXB Creek area is about 30%. So that tells us that 50% of all supply is in those 2 submarkets. If we look then at where supply is expected to go, so left of that line, left of the vertical lines you're looking at here is historical performance, right of it is where we expect Dubai to go for the next few years. So the teal coloured line being your supply growth. So supply is going to continue to increase. Demand too will continue to increase, albeit at a slower rate than what we're seeing for demand. So we're saying rooms currently at 140,000 by 2020. Now we do build in attrition into that of about 25%. So attrition for projects that may not go ahead, or indeed projects that may get delayed and not open in time. So if we look at that in a little bit more detail, so if all the markets, and I can't stress enough the if all of the hotels in these sub-markets come to fruition, there'll be another 30,000 rooms in Dubai, and this is where they'll sit. So heading towards 11,000 on Jumeirah Palm, another 13,000 down at DXB and Creek, another almost 10,000 in downtown and Business Bay. And that is, like I said, a big if it all comes to fruition. What does that look like then in percentage terms? So about 20% more in the Palm. Some of you will have seen recently that there was an announcement that 4,000 rooms in the luxury segment will open on the Palm this year. Now, whether all that will actually happen remains to be seen. But the interesting part, and Robin presented this particular piece earlier on this morning, the interesting part is that the biggest bulk amount of the new supply coming in is actually in Dubai surroundings. That's 27%. So maybe let's call it the non-traditional area for hotel rooms to be entering the marketplace. Touching a little bit on forecast, again, the left-hand side that you're seeing here, the greyed out piece is all the past, the right-hand side is the future. So we do expect Dubai to continue to decline, both occupancy and average rate, as that new supply tries to bed in over the next number of years, and up to and including the Expo period. If we look then where we're expecting that to level out, so you'll see average rate to sit a little bit under 600 dirham by year end 2019, and then what that percentage change is on the right hand side of your screen. So seeing occupancy and average rate declines through 19, and occupancy declines into 2020 and indeed 2021. So some of the takeaways, just to leave you with something to take away back to your hotels and your operators and your owners, etc., is that pre-mega event supply increases by somewhere around 5 to 6%. Now they're kind of headier numbers in the Dubai market, but somewhere around those, we look at all those 9 different mega events that we've looked at. Demand typically falls in the months and days ahead of any mega event, and typically falls certainly in the immediate aftermath of any mega event as well. Remember as well that Dubai is trading at a very high occupancy already. It's trading at 82% occupancy already. If you think of Shanghai post-Expo, Shanghai's at about 74%, and during's at about 55%. Markets with lower occupancies tend to generate stronger new demand because of the greater availability, and seasonality in business mix is very, very important. So if you're looking at summer versus winter months, if you're also looking at corporate versus leisure. And the last 2 Expos did see both ADR and occupancy increases over that 6-month period. So certainly on our way to generating that 20 million demand, although the likelihood is that average rate will continue to fall. So thank you.